The contemporary financial landscape is underpinned by a collective illusion, a sort of hypnosis that hinges on a scoreboard measuring nominal prices, while the steady erosion of real value goes largely unnoticed. As the world approaches the year 2026, this structural deception is on the verge of a significant reckoning. This situation is often misinterpreted as a simple speculative bubble or a series of market scams. However, the current volatility in precious metals is merely a symptom of a more profound regime shift. The transition towards what many refer to as the 2026 reset signifies a movement from a realm of paper promises to one characterized by tangible scarcity and the unforgiving mathematics of debt. The inherent deception within the current monetary system does not lie within the assets themselves, but rather in the incentives woven into the fabric of debt. For decades, the public has been conditioned to pursue nominal gains, the rising numbers on their screens, while overlooking the quiet siphoning of purchasing power. This illusion is upheld through three primary layers: pricing, narrative, and policy. The pricing of precious metals is predominantly influenced by paper markets, including futures and derivatives, which often multiply far beyond the actual physical supply. This results in a temporary decoupling of price from physical reality. Concurrently, the narrative illusion employs media-driven emotional manipulation to keep investors reactive rather than proactive. Lastly, the policy trap ensures that governments, addicted to the expansion of debt, prioritize liquidity over the credibility of their currencies. History indicates that when faced with the choice between dismantling the debt machine or debasing the currency, policymakers almost always opt for the latter. Central to the 2026 reset is the interplay between debt and real interest rates. In a healthy economy, interest rates should provide a real return to savers. However, in a world burdened by unprecedented sovereign debt, central banks find themselves unable to permit real rates to rise significantly without triggering systemic defaults. This creates a ceiling on interest rates. When inflation remains persistent while interest rates are capped, real yields turn negative. In such an environment, the opportunity cost of holding gold and silver diminishes significantly. Gold, acting as a thermometer of trust, begins to reprice not due to an increase in utility, but because the unit of account used to measure it is losing its integrity. This situation is not a conspiracy. It is a mathematical adjustment. As the system relies on inflation to erode the real value of its liabilities, gold becomes a release valve for suppressed monetary pressure. In this strategic intersection, gold serves as a referendum on the credibility of fiat currency, while silver occupies a more intricate dual identity role. Silver is both a monetary metal and an essential industrial material. Its necessity in electrification, 5G infrastructure, and advanced electronics creates a structural drain on above-ground inventories. Unlike gold, silver is predominantly a byproduct of other mining operations, rendering its supply inelastic. It cannot quickly respond to price signals. As we approach the year 2026, the convergence of industrial demand and monetary anxiety creates a choke point. When the market recognizes that supply cannot be printed or easily expanded, the resulting repricing is often abrupt and violent. The anticipation of triple-digit silver is not merely an audacious prediction. It is a plausible outcome of a scenario where industrial necessity collides with a loss of faith in paper assets. The most challenging aspect of the 2026 reset is not the economic data itself, but the psychological discipline required to navigate this shifting landscape. The financial system thrives on churn, the constant influx and withdrawal of emotional investors who buy at the peak of a narrative and sell at the trough of a correction. This behavioral loop is the mechanism through which wealth is transferred from the impatient to those who are strategically positioned. Preparing for a reset necessitates a shift from speculation to insurance. It requires introspection and diagnostic questioning. What is the trajectory of real yields? How rapidly is global debt expanding? What actions are central banks taking? Currently, central banks are accumulating gold at unprecedented levels, signaling that even the architects of the fiat system are beginning to recognize its limitations. The 2026 reset is not necessarily an apocalyptic event. Rather, it represents a recalibration of value, as the anchors of the past, such as low debt, positive real rates, and global stability, begin to snap. The market must seek a new equilibrium. Targets like $6,000 for gold or $100 for silver may seem extreme only when measured against a regime that is rapidly fading. Ultimately, gold and silver serve as measuring sticks, revealing the truths that the system attempts to obscure, that purchasing power cannot be printed. As we move forward, the most significant risk lies not in the volatility of these metals, but in the emotional trickery of a system designed to prevent individuals from holding the only assets it cannot dilute. Survival in this new era hinges on understanding the structure, respecting the cycle, and recognizing that when trust in paper assets falters, the world invariably turns back to the tangible.